Thanks for coming and being our guest today, Stephen, of FORVIS. It's wonderful to have you here. I know that people might not necessarily be thinking about their taxes, but this is exactly when you need to start thinking about some of these things, right? That you need to think about your year-end wrap up and what you're going to be facing for the following year, and then even some things that you can take advantage of possibly still for 2022. So it's great to have you on board.
Yeah, absolutely. Thank you very much. I was actually talking to my wife yesterday and forgot completely that next week is Thanksgiving. So the year end is coming up faster than we know it. So yeah, I think it is a perfect time to start talking about these things and make sure that we get everything done that we can be in between, Thanksgiving and Christmas and other holidays that we're heading into. So yeah, great timing here. Thanks for having me on. And I'll go ahead and get us kicked off. And I'll just mention we have a ton of slides here today, about 80 slides. So in the time that we're allotted, I won't get to all of them, but if there is a particular topic that I may be glossing over that's important to you, feel free to use maybe the Q&A feature. Just, send me a quick note if you'd like me to go over one of the items in particular that you see. That way we can cover things that are important to this audience. But outside of that, I'll try to just hit the highlights that I think will be applicable to most of the people on this call.
Great.
All right. Well, with our agenda, we have some legislative changes, some new guidance by the IRS, and then we go into some more of the tax planning, the gift and estate planning, additional year-end developments, and some year-end planning reminders. So we'll start off with the legislative changes. The big legislative update is the Inflation Reduction Act of 2022. This sort of was born out of the Build Back Better program that was not enacted, but they sort of came back with a smaller package called the Inflation Reduction Act. A lot of the act obviously focused on some social, tax, and climate provisions. Today, obviously, we'll be covering mainly the tax side of it. But if there's any other questions, feel free to ask, and we'll try to get some answers to you maybe after the presentation. These first couple of items I'll probably gloss through. Again, there's some corporate updates mainly targeted towards larger corporations or publicly traded corporations, things like a new AMT and an excise tax on the stock buybacks, again, likely for larger corporations. So just be aware of them, but likely will not be affecting most on this call in their day-to-day work. The first provision that's interesting is that the extension of the excess business losses. Now, this provision was originally through the 2018 Act and was set to sunset in the end of 2026, but it is now being extended through the end of 2028, December of 2028. This provision is a reminder where if there is a loss from a pass-through business, for example, an S corporation or a partnership, that total loss cannot exceed certain levels. In 2022, I believe for a joint taxpayer, married filing joint, that is a $470,000 limitation. So by way of example, let's say your business had $1 million loss, you can only apply up to about $470,000 of that loss to other items on your tax return, whether it be W-2 wages or income from dividends or interest. So just be aware of that in your year-end tax planning. If you were unfortunately not in a position where you were making money but had substantial loss, you still may be taxable depending on other factors of your tax return, even though you may have a large business loss. So just as an FYI, that is in play this year, and right now will be in play through 2028. Next, there's going to be a series of tax credits that are within these within the slide deck because it is part of the Inflation Reduction Act. I'm going to hit some of the highlights here, the ones I think are broader credits available to most people and applicable to most people. The first one being the clean vehicle credit. We have had this credit or a version thereof for years now, mainly targeted at plug-in electric vehicles. This credit basically allows potentially up to, I think it's $7,500 for an eligible vehicle. One of the big changes, though, that I think is important is the fact that the vehicle list has been updated, and some of them may or may not qualify. One of the bigger ones was Tesla recently fell off the list because
Hmm.
of the popularity of that vehicle, but I believe that one is now back on the list for this one. So there's a wide range of vehicles there. The credit is in place now. So this is just an incentive if you're considering that type of vehicle. Just know that that might be out there to help offset the cost of that new vehicle.
Stephen, I really like this slide because, not only am I personally interested in some of these measures, but Blue Ridge Bank has been invested in ESG, which stands for the environmental, social, and governance. It's companies that are looking they always consider these three factors when making their investment decisions. So we've been having a lot more paying attention to things that are environmentally and socially friendly. And for example, this past year, we opened up 2 free charging stations that we have in our Richmond branches. So we've tried to do what we can in order to help have those stopping points for clean energy vehicles to go and fuel up. So this is great.
And it's great that you mentioned that. There's actually not included in this deck, but there are additional incentives that may not be incentives on from the federal level through the Inflation Reduction Act. For example, there is a Virginia-based credit, a state tax level credit for costs associated with installing those types of charging stations. So if you're a business owner or a property owner and you're looking to install one of those charging stations, it's something to look into that may help offset potentially the cost of installing that charging station at your property.
That's great.
Also wanted to mention here, I think normally when we were looking at this credit, these clean vehicle credits, typically it applied a lot of times to the passenger vehicles, like I mentioned, Tesla, and some of the hybrids that had come out years before that. There is also one targeted towards the commercial vehicles. So these are ones that maybe are heavier, has some heavy duty vehicles that maybe were potentially powered by diesel in the past. So this also provides potentially a $7,500 credit for those. So if you do have a business that uses these types of larger, work type vehicles, there may be a credit out there as well to help offset that. And I guess with the vehicle prices these days, it might be a welcome benefit. So certainly something to consider as you're looking through and potentially planning some vehicle purchases.
Great. And I want to remind anyone that might have joined our meeting late that if they have any questions, there is a chat section on here that they can submit their questions and I'll catch them and we can serve them on up to you. So thanks. Keep going, please.
So, and just the last vehicle credit I'm going to touch on today, there is one that is a smaller credit, but it does apply to previously owned or pre-owned vehicles. Typically, they had to be newly purchased vehicles to apply for some of the other prior credits, but there now is a potential avenue for used vehicles to also get an offsetting credit, which is nice as we're seeing maybe more of those hit the market. These next few credits generally are on the business side or for electricity or other fuel production. So I'm going to skip through these again. Happy to field any questions as I'm sort of walking through the slides. If you all see one, feel free to ask a question or raise your hand. We can certainly touch on it a little bit more. Otherwise, we'll try to make these slides available to the group so that if there's a question afterwards, be happy to share the contact and we can certainly talk offline. I will stop at this one. This is an interesting one, the non-business energy production credit. This is one where if you're doing qualified energy efficient improvements to your personal residence or another non-business property, previously there was a lifetime $500 credit that was eligible to individual taxpayers. That has now changed to a $1,200 annual tax credit. So if you're doing something over the course of a few years, you can take advantage of this on an annual basis. So something if you're considering any sort of upgrades. I know in my neighborhood, I saw a ton of upgrades through the pandemic. I think people were just sort of doing some remodeling as they were stuck in their homes. So if anyone here is thinking of doing that, you can certainly potentially get a credit and help reduce the cost of that spend there, in addition to just having the energy efficient property itself.
Yeah, absolutely. I know that we personally have taken advantage of this when our washing machine died, and then ended up getting one that was a lot more energy efficient. And then when we've even installed windows, we live in an older home, so those kinds of things. If you ask the right questions and you get the right thing installed, you can definitely take advantage of it. It helps offset some costs too. And you and I were talking about some of this before the meeting too, and how this could play in with some HELOCs too.
Yeah, absolutely. I mean, these are not necessarily cheap, but using a combination potentially of the credit or other credit sources outside of that, maybe like a HELOC loan, given potentially where some homes have appreciated. There's avenues to maybe finance this either through a tax credit or through a credit line that something like Blue Ridge may be able to provide.
Yeah, absolutely.
I'm going to now jump to another credit that's actually focused on commercial buildings. In a similar vein, this is actually not a credit, actually, it's actually a deduction called the Section 179D deduction. And what this deduction is if there are eligible costs in terms of retrofitting or updating commercial properties, there's a potential deduction based on the scale of that improvement. One of the bigger ones is energy efficient lighting. So a lot of my clients are going to like an LED or something more efficient than the old tube lighting actually that I have above me. So if you have like a large warehouse or a large office building or something like that where you're doing some extensive lighting upgrades, there potentially is a deduction for that, and it's actually not based on the cost of the lighting. It's actually based on the square footage and also some energy savings. So something to talk about again if you're looking at upgrading or retrofitting a building, this is just a deduction that may be able to help pay for that cost, right? In addition to what other sources of funding you may be getting.
I love all of these, that you've been mentioning, because there's so often that when you're when you're faced with some of these topics of making choices of what you're going to install and what you're going to build and do, a lot of these deductions can really offset that, and then couple that with, movements that a lot of companies are doing with joining the ESG movement.
Mhm.
It really does benefit you to slow down and to think about, hey, let's do this right. The long road ahead, we're going to not only face some decrease in our monthly bills by going energy efficient, but we're also going to get this credit, and we're also going to do the, something that's environmentally conscious. This is great.
Yeah, absolutely. And oftentimes some of those barriers to entry are the cost, right? Because they may be
Mhm.
newer technologies or lesser used technologies. So it may be more costly than the standard or traditional solution. But potentially, some of these types of credits and deductions may reduce the cost enough to where it's now part of the discussion. So as you mentioned, sort of getting all those ancillary benefits and using a newer technology, but only having maybe a smaller incremental cost to that. I'll sort of mention here, I'm not sure if this is going to apply to a lot of folks on the call, but traditionally with these credits that we've talked about, oftentimes you file your return and then you sort of claim a credit on your tax return for certain entities like tax exempt entities or state and political subdivisions. You can actually use it as a direct payment of your taxes versus the traditional credit mechanism. So just bringing that up there, I mean, we're all conscious of cash flow and things like that, especially as year end comes with final bills or maybe employee bonuses or other things like that. So if you are eligible for this type of solution, it may help with your cash flow needs. If you have sort of a credit available to you, it may allow you to claim that faster, really through that reduction or direct payment of the tax instead of waiting on a credit to come back to you. But again, the list of eligible taxpayers is fairly restrictive, but if it applies, it's something to certainly review. Um, I'll touch on this. I won't go into it too much, but a lot of my clients do ask me about the IRS funding, because they think it's going to affect me every day, and it could. So obviously the IRS has been currently allocated about $80 billion to sort of upgrade their systems, hire additional staff. Um, you know, the thought there is that one is to improve taxpayer services. I think I just saw something on the Wall Street Journal. There's going to be a focus on hiring customer service facing employees. Folks that I don't know how much of you call the IRS. I do way too frequently, but sometimes you're on the phone for an hour or more. So obviously hiring more of those customer service representatives to maybe streamline that process or make it less painful to help people get answers is helpful. And then obviously there's big talk of the agents there. So that's still on the table. We're thinking about it. My clients are thinking about it. It's just making everyone aware that it is something to be aware of and monitor. The other large bill that did come out that had some tax implications was the CHIPS Act. Again, I'll gloss through this. I think it's more of a niche credit or a niche sort of program because it does just target producers of semiconductors. But if you are in that space, obviously, if there's some costs that you're incurring for that advanced manufacturing, just be aware that there is some credit programs out there that may be available to help offset the cost of establishing those maybe new capacities or updated equipment. Again, here are some more minor, call it minor. They weren't sort of in the larger, more sort of publicized, acts and laws out there, but just a few to be aware of. One, if you've ever taken advantage of foreign tax credits on your business tax return in particular, the definitions and regulations surrounding what qualifies for that foreign tax credit has been updated and changed slightly. So if that's something you've used in the past and has been material to your cash flow and tax planning, just be aware that there are changes. Therefore, you may need to circle back with your tax advisor to make sure that the items you thought in the past were eligible continue to be eligible under these new rules.
That's just a nice gentle reminder that your tax advisor has to keep up with all these things changing all the time. It's sometimes difficult to remember to know what to ask for and what to serve up that you've got that they need to know about. You have to have that relationship for sure. And you guys keeping up with these kinds of details is critical.
Yeah, no, I definitely appreciate we have like a national tax desk who boils down all these thousands of pages of documents into this nice 80 slide deck for me. So definitely appreciate folks like that. Again, just kind of skipping through some of these, not as big for most folks. Kind of here getting sort of the meat of it all. I think these last few sections are going to be applicable again to more of the audience and something you'll kind of see certainly at year end for most people. The first thing I'll cover is sort of the estate and gift tax planning. A lot of this does happen at year end. I remember it was a few years ago when there was talk of potentially the estate tax limit going down from the current level at the time was about $11 million and it potentially going all the way down to $1 or $5 million. There was a flurry of activity to sort of lock in some planning and some gifting before that potential change. Obviously didn't happen and we're still at that sort of higher level. Again, it was about $11 million a few years ago. And as you can imagine, with inflation that we've seen recently, we're starting to see some of these inflation indexed limitations being increased. So for 2022, the estate tax limit is 12 million and goes up to almost 13 million for 2023. And also for a long time, the annual gift exclusion was $15,000. That has now gone up to 16,000 and 17,000 in 2022 and 2023 respectively. As a reminder, I do think a lot of the folks are able to take advantage of this gift tax exclusion. This is where you are allowed to give an individual a gift of up to, in this case in 2022, up to $16,000 per individual in your gifting and not incur a gift tax. We see this quite frequently at the end of the year for things like 529 contributions. We'll see this with just annual gifting strategies. For example, we'll see a lot of maybe grandparents who are looking, sort of at their estate plan and they may be gifting annually to grandkids, either in a 529 or some other type of account. So just a reminder, if you all have that strategy or can take advantage of that strategy, these are the limitations so you can plan accordingly.
Yeah, that's great. Excuse me, you and I were speaking about this before the meeting. That is something where me personally, I'm one of those folks that they call the sandwich generation. And means I have kids and I have aging parents and I'm in between both and taking care of both. And we've definitely faced some more recent challenging discussions about what do we do with the aging parents. And there's always been this strategy in the back of my mind that have them do the annual gift tax exclusion in order to try to figure out where do those funds go should they find themselves suddenly put into a federally funded retirement home, and trying to have these conversations. And actually, to be honest with you, I thought it was significantly lower than what this was, because I think the last time we even toyed with it was at a younger point in our lives. But now that we're actually seriously facing it, seeing how high it is great. And to see that it goes up again next year is also great.
Yeah, exactly. And it can actually grow beyond this. I think the $16,000, it can grow to be pretty powerful in a scenario like yours, where if you sort of do have both parents still alive, it's $16,000 per. So a lot of times you'll look at sort of
Mm,
um,
good
that
point.
married couple. So that's basically $32,000 per person, and then you kind of spire that out to like you and your spouse and then all of your kids. So it can actually be a pretty significant number every year. So if you do have a goal in mind, for example, for retirement home planning or something like that, this while maybe if you have a larger state, 16,000 doesn't seem like a lot. Like, how would you ever chip down your estate to a relatively low level? There are strategies and other things to consider. Actually, I'll move on to the next slide. There's the gift splitting and
Yeah.
using certain trusts and things like that that can actually increase that potential. So if that is a strategy, again, we will typically see this at year end with the holidays rolling around and things like that. It might be part of what they're doing as a total gifting strategy. So again, just a reminder of the limitations, something to be aware of. And if you haven't thought about it, maybe something to talk to either your CPA or an attorney about that as well.
And, shameless plug here, this is where we have our division of the BRB Financial Group, which consists of both wealth management and our trust advisors. And we talk about estates all the time with the tax or with the trust advisors. So that would be something that we can help with as well.
Yeah, that's a perfect example too as well. A lot of my clients are sometimes hesitant to gift some of this money, even though it may fit within their gifting or state strategy, because they don't want their grandkids to have access to those types of
Yeah.
funds. So it's often up to us partnering with either the attorneys or folks like Blue Ridge's wealth management division to basically set up either trusts or other vehicles so that
Yeah.
they can gift the way they would like to and according to their plans, but make sure that their kids and grandkids are sort of earning it and are ready for it at the time. So that's
Yep.
probably half the discussion we have is I'm happy to give it away, but I want to make sure that we're doing it intelligently and along with the considering the people that we're giving it to.
Yeah, absolutely.
These are just, again, some more of the strategies. These are sort of a step up, I would say, in sort of complexity and effectiveness from that annual gifting. The annual gifting could be as simple as, writing a check, right? And just giving it to somebody. It's as simple as that. Some of these vehicles, the family limited partnership, installment notes, things like that, these are potentially for larger gifts if there needs to be either a larger value shifted out of the estate or the estate is more complex. Not sure if we have a lot of multi-business owners or something like that, but typically that's where we'll see some of these strategies when we're looking at transferring value or transferring a business to the next generation of business owners, and that may be within the family or without the family. These are all strategies that we will employ to help do that intelligently, both considering the succession planning that we may have or the family planning, but also dovetailing that with our estate planning as well. There's also, interestingly, and I think we're going to move to some of this as well, there's a couple of vehicles that if anyone on the call is charitably inclined, there are a couple of charitably focused trusts where you can use that vehicle to carry out some charitable wishes as well, while also retaining either some cash flow or some ownership in your property as well. One of the ones we have an example of here are the charitable lead annuity trust, where um, you will actually set up sort of some charitable gifting through the trust, but still maintain some of the benefits of that property, even though you have some outflows to charity. So a lot of different strategies, either using it to help out family, other individuals, other relationships you have, but also some charitable items as well.
So let me ask you, in our BRB Trust division, we have a couple of scholarships that we offer every year that are left behind from other people's estates. Is it that kind of charitable giving that you're mentioning, or is that a different kind?
It could be. It could be. They could be setting up something like that. We'll see that often with some private foundations where they'll set that up and set up a scholarship fund.
Mhm.
Or we work with a lot of universities and things. We'll see that as well. Some of these also, we do have clients that throughout their life have had causes that are close to them. That one that we see often is the Richmond like SPCA, for example. So maybe
Right.
they've been highly involved with the SPCA during their life and want to provide for them maybe even after death. And so they'll set up one of these trusts that it basically gives them on an annual basis money out of the estate moving forward, or through the trust moving forward to help continue to fund programs like the SPCA or other nonprofits in the area.
Great. Thank you.
I'll mention this as well. So the IRAs, and specifically Roth IRAs, are obviously a nice retirement planning vehicle, um, where there are limitations to the contributions. You can see here for 2022, it stays at that $6,000 level. Um, so just a reminder that if you're considering these, it could, maybe time to start thinking about that cash planning, time to think about your contribution levels. If you're going to do one sort of outside of work, like our plan does it automatically through work, but if you're doing one outside of that, certainly something to think about this time of the year. The Roth IRA specifically, if no one's familiar with that here, it allows you to use post-tax dollars to invest in your IRA, but then you can actually withdraw that money tax-free. So it's an alternative to the traditional IRA, which is in the reverse, where you use pre-tax dollars as your contribution, but you are taxed on your distributions in retirement.
I personally maxed out Roth IRAs as long as I could. That was definitely something that I was very interested in when it was newer. It came out, I want to say in the 80s or 90s. It's
Yep.
more relatively new.
Hmm.
So that was the kind of thing that, my parents' generation, the boomers, had never really even heard of or understood at the time. So it's definitely something that has gained traction, but it was very exciting to do that for the tax reasons that you mentioned.
Yeah, and actually that kind of brings up another point. I think the other benefit that we used to have with these is that under a traditional IRA or 401k, things like that, there is the required minimum distributions that force you to take deductions when you reach the age of, for example, 70 and a half. Some folks did not like that as much because maybe they didn't need that money, so they wanted to leave it in and let it continue to grow. Roth traditionally did not have that RMD requirement, although that is changing a little bit. Obviously, the Secure Act, as you can see, they're eliminated that stretch out option. So it's in a way forcing a little bit of that withdrawal. So there's not as much benefit in that side of it anymore. But that still is a benefit of the Roth. So it does help to sort of have maybe that vehicle available to you to help with your cash flow planning as you head out into the retirement years. Again, mentioned this earlier with that charitable lead annuity trust. But obviously, as we head into the holidays, we see a lot of charitable giving this time of the year. Obviously, people give throughout the year, but this is the time where it's sort of top of mind with the holiday season. So these are just a few of the examples of charitable giving options. Obviously, you can, similar to, for example, the gifting strategy, you can simply give cash, but there's also other strategies that allow you to sort of dovetail your charitable giving with other strategies you may have. For example, one of the bullet points, the contributions to the donor advised fund, that's one where you sort of establish a fund and you will basically control how those funds are used, right? So you kind of give charitably, but you still have control of how that money is used, how how those contributions are made. So some people like that because they do want to give, but they want to have some say in how they give and how that money is used. So that one is one where it sort of achieves the charitable contribution or charitable objective, but also allows people to sort of be mindful of how their money is being used ultimately.
Let me ask you, and apologies that I'm commenting on your slides. I think a lot of this is interesting and exciting myself. But the um, the charitable taxes, didn't that change with President Trump? Wasn't there something that changed that there was no? Is that just deductions of a certain kind?
Yeah, yeah. So what had changed is if there is a credit, tax credit associated with the charitable contribution, in prior to the change, you could actually take the full charitable deduction. So let's say an example, let's just say you made a $10,000 charitable contribution, you could take $10,000 as a tax deduction. But if you got, for example, a $2,000 tax credit associated with that $10,000 deduction, you would sort of take your $10,000 deduction and you would also take your $2,000 tax credit. Now you cannot sort of double dip on those amounts. So if you get the
Ah,
$10,000 deduction, and also the $2,000 credit, you have to subtract the credit amount from the deductible contribution. So now you get an $8,000 deduction and a $2,000 credit. So a little bit less tax efficient, although there's still some benefit there.
yeah.
So it has changed a little bit. So something to be aware of. I think where it really comes into play is if you're making a larger contribution or you're getting obviously some credits associated with that. Something to consider. A lot of my clients will use the Virginia-based neighborhood assistance program credit, where if you donate to um, eligible nonprofits, you can sort of get this. We call it a NAP credit. So those are pretty popular because you got a full deduction. You got this pretty powerful Virginia tax credit. That obviously the effectiveness has been reduced, but there's still some benefit there, and it's still benefiting a lot of great organizations. So still something to consider doing as well.
Okay. What's NAP stand for?
The neighborhood assistance program.
That's what you said. Okay, excellent. Thank you.
Touched on this earlier, again, the 529 plans, another savings vehicle. Again, the reason to bring this up for year-end planning would be that the contributions have to be made by year-end for certain deductions. For example, in Virginia, you get up to a $4,000 deduction per plan if you contribute that money prior to year-end. So if you have any 529 plans currently or thinking about setting one up, a good time to make the contribution and do so. If you make the contribution again to the plan, you'll get up to a $4,000 deduction. So a little bit of benefit there. Obviously, you're hoping to benefit the donee, maybe a child or a grandchild, but also you'll still get a little bit of benefit yourself, right, by getting that slight tax deduction on the Virginia side.
And this is something that our BRB wealth management team also can help assist with setting up and talking folks through. Quick question for you on that one. The ownership piece. What is your advice? I'm just curious if the 529 goes in the child's name or the adult's name. I've heard
Um,
different things.
Most of the ones I see are still in the name of the adults.
Okay.
They'll do it in the benefit of the child.
Okay.
And I think I see that a lot of times because just in case, I guess, the individual doesn't go to school, the adult
Ah,
can still retain those funds. There's obviously some tax consequences to that if you don't use the funds for qualified expenses, but it's a way to sort of, similar like we mentioned with sort of the trust programs we talked about before, people being mindful of what that money is used for or how people get access to that money. Um, Keeping the ownership name, I guess, in the adult side allows you to maintain a little bit more control.
yeah, a lot of considerations for sure, right? That's always a good reason to have some smart advisors to talk to figure out the different advantages and disadvantages too.
Yep, absolutely. So, no, a great program. I think, thankfully, I have my in-laws have started one for my kids, so we can chip away at
Excellent.
that bill. But no, so I appreciate them that doing that, and it can be a valuable plan. And again, hopefully, she's taking the benefits for herself on the Virginia side. Although I do refuse to help family with things like taxes. So not
That's
sure if
smart.
she is.
That's smart. Got to separate it sometimes.
Okay. Just a few more reminders, similar to the gifting levels, just some reminders of some benefits that are available as we head into year end. The next few slides we're going to talk about are for business type property. This one specifically is for autos. As everyone knows, we're still in a position where we're able to take bonus depreciation. So this is helpful if you're planning any auto purchases, especially in this environment where costs have gone up. you can get a potentially fast write-off of the cost of that vehicle to help you sort of recapture that initial expense. These are the various depreciation levels that are available for vehicles. So just something to be mindful of. It can be part of the equation of, again, how we talked about how do we, make the cost of some of these things a little bit cheaper. This one reduces your tax bill and can be a consideration. Section 179 is a business tax deduction similar to depreciation, where it applies to a whole slew of business property. We often see it with the purchase of computers. Again, it applies to certain vehicles, office furniture. So if anyone is returning to the office, from any sort of exit from the pandemic, if you need to retrofit your office, like we're actually, because of our merger into FORVIS, we're having to rebrand everything and repaint everything. So I assume they're taking advantage of something like this, but it certainly helps offset some of the cost of some of the business equipment required
Yeah,
to
definitely.
operate
And
everything.
it is a changing landscape with the post-pandemic world. So it's a good point.
All right, a couple of individual things. Just this is the standard deduction. Just the IRS has released sort of these levels. Just putting it up here for everyone to have a reference of. Obviously, with the inflation we had, similar to the estate tax, you were seeing some of these individual annual items go up as well. So, in a way, it's nice. It will help slightly reduce taxes for those who are not able to itemize it with the increased standard deduction, but here are the levels there. So not groundbreaking, but just as an FYI. This is an interesting one. I did see quite a bit of alternative minimum tax with my individual clients in 2021. As you could imagine, with the market the way it had been, we saw significant capital gains. We saw with a lot of that IPO activity, we saw a lot of the stock option exercises and eligibility there. So surprisingly, we saw a lot more alternative minimum tax than we did. And the reason I say that is, as you can see in that third bullet point, it's a fairly high threshold. You're typically not subject to it unless you're sort of in the higher tax brackets. But because of those one-time events, maybe some large capital gains or some cash outs of some stock options, we did have some clients go into that territory. So with the market being where it is today, I'm not sure if we'll see as much of that in 2022. That being said, there may still be some stock option activity or something like that on a personal level. So just be mindful of that. It may, give you an unexpected tax bill at the end of the year because this alternative minimum tax does have a higher rate than the ordinary tax. So again, just don't want to have that surprise come April. All right. Let's see, the qualified business tax deduction. This is one that is associated with pass-through businesses. So your partnerships or your S corporations. We've had this since about 2018. This is the additional 20% deduction on your business income, but it does have some phase outs depending on your industry and things like that. So here are the new levels, obviously indexed for inflation. So just something to be mindful of as you're doing your year-end calculations and sort of estimating your taxes, what deductions may be available based on these new threshold and phase-out limitations here.
Oh, I know this one well. I actually do this one.
The standard mileage rates.
Mhm.
Yeah. Obviously, that has gone up given where gas prices are,
Oh,
but
yes.
generally no changes in anything, just changes in the amounts there. Another good one here, similar to, like I said, the 529 and other contributions that may need to be made by year end. Just these are the new indexed rates for 2022 and 2023 to consider. So if you're needing to make any more HSA contributions, just being mindful of these limitations as you're not supposed to go over them. But here are some new amounts as well. Again, this is a good one, actually. This is a nice, because of the inflation, we have seen an increase in eligible contributions to the retirement plans. It had been fairly steady for the past few years. So now that it has gone up, it just provides more opportunity, obviously, for setting up for the future, setting up for a nice retirement there. So as you're thinking forward to 2023, Just maybe think through those and make sure you're setting your deductions and your planning accordingly to take advantage of the increased contribution levels. All right, last section here, year-end planning reminders. Excuse me. Going back to the bonus depreciation, this slide is actually based on the 2018 Tax Act, where for a long time now we've had 100% bonus available to us. And what that basically allows you to do is for eligible property, again, computers, furnitures, and fixtures, those could potentially be deducted all in 1 year, which was a pretty nice tax benefit there to help recover some of that cost of the equipment through a reduced tax bill. So through the end of 2022, we'll still have 100% bonus deduction, but as you can see here, the bonus deduction will decrease 20% per year through 2026, and then it is currently set to phase out at 2027. So
Wow.
bringing this up here, if you have any significant fixed asset purchases for your business, again, I know our firm, because of work from home, we had to purchase a ton of new monitors and other things so that people had a proper office set up at their home office. So obviously this was beneficial to help offset that cost, but this benefit does become less powerful over the next 5 years and then does go away. So maybe to be mindful of that in your long-term planning, your long-term capital budgets, of what benefits you may be able to get out of that required spend to keep your business running.
Yeah, so maybe when we all see the Black Friday ads, that's the time to go out and get those digital cameras and those printers and those iPhones for your business, right?
Yeah, yeah, absolutely. It's get a good deal on the front end and then have the tax, help out with the cost at the end of the year.
Wow, interesting. I did not know this was happening. Thanks for sharing that one.
So fringe benefits, just a reminder that some of these are W-2 adjustments, things you may need to add to your employees' W-2. So just to not miss those, obviously to report that properly for them so they can file their returns in turn correctly and just streamline it for them. And more IRS things, I'll kind of gloss through that. This is a big one. We're actually having active discussions about this. So as part of the TCJA, businesses are now required to capitalize and amortize for domestic research and development expenditures over 5 years. And if it's actually foreign research, it's over 15 years. So backing up a little bit, research and development expenditures were deducted in the year in which they were incurred. So we'll see this a lot of times potentially if people are developing apps or updating websites or something like that, or like, for example, if you're a manufacturer, if you're doing any sort of tinkering on your line, on your manufacturing line or your manufacturing processes, all of those costs, the spent materials, the wages paid for engineers, those were all currently deductible. Starting in 2022, so this year, those are now capitalized and amortized over the next 5 years. So something to be mindful of, where in the past you may have gotten a nice deduction for that, you will still get the deduction, but over 5 years, so it could potentially add to your net income, your tax net income, and therefore add to your tax bill. So something to think about as you're thinking about year-end planning. As you're walking through that, maybe with your CPA or your advisor, if you are, sort of R&D heavy, you'll want to consider this because it could create a tax cash flow issue for you, come January, April. So just throwing it out there. It is a pretty broad, complex topic, so I won't dive into it too much today, but just be aware that it's out there and should be considered over the next month or so as you kind of close out year end. Payroll tax deferral. I'll mention this again because the due date is coming up. So under the CARES Act, you were allowed to potentially defer payment of some payroll taxes. This was, part of the packages to help businesses sort of maintain cash flow or reserve cash if things did get tight because of the pandemic. So 50% of that was due by the end of last year, and then the other 50% by the end of this year. So if you all did take advantage of that payroll deferral, a reminder that that last deposit will need to be made next month. So we'll not want to miss that deadline. I'll mention this one briefly, just as a reminder. Um, during the pandemic, some of the legislation that came out during that time suspended some of the limitation on things like net operating losses, basically to allow businesses to use those losses to offset some of the tax bills, obviously to help with cash flow, reserve cash, and things like that. Uh, those have all now come back and have come back into play. So just something to think about if you had some losses that you used to shield against tax liability. That may not be possible this year. So something just to be mindful of so that you are thinking about it appropriately and are anticipating potential cash needs for tax and planning for that appropriately so there's no surprises. The employee retention credit, I'll touch on this. This credit, I'm not sure how many people on the call were able to take advantage of it, but it was actually sort of a lesser known or a lesser thought of program within sort of the CARES Act. Because initially, if you took a PPP loan, which I don't know very many businesses who didn't unless they were larger, if you took a PPP loan, you were not eligible for the employee retention credit. So a lot of people did not think about that because they took the PPP loan. But there was a period where that guidance changed, and they now open it up to where even if you did take a PPP loan, you were now eligible to also take the employee retention credit. So it sort of came roaring back into the public consciousness. The program did end actually in the Q3 of 2021. So Q4, and then obviously in Q3 of 2022 is when it ended. So no longer eligible as of this current quarter. However, you can always go back and amend payroll tax returns for up to 3 years from the date that they were filed. So in looking at this credit, if you are potentially eligible for it, it's time to have those conversations with either someone like a Blue Ridge, someone like FORVIS, or maybe a payroll provider. There's lots of different companies that are assisting with this, but there is still a window to claim these credits if it is indeed eligible to you as a business. So again, won't go into too much detail here, but just making aware that even though the program has sunset, there's still some opportunity to take advantage of that program.
Yeah, I'm glad you mentioned that. We are partnering with a company that is called Innovation Refunds, and we will be pushing out some communication on that in the coming weeks. We're just trying to get a couple of things solidified in the back end, but it is just that you can always go back and this group is actually there's no fee to use them. They're free, and the part where they get paid, they take a percentage off the top. But some really interesting stories of how they've been able to go back and to recoup, multi-thousands of dollars for some companies, and that's their whole business. That's their focus is just this ERC, and there is still time to go back and to recoup some of those expenses. So Blue Ridge Bank is working on that. If anyone had any questions, definitely reach out to us. So thanks for that one, mentioning this.
Absolutely. The pass-through entity election. This is interesting. I'm actually on the VSDPA's tax committee, and this came up. So Virginia actually just issued some guidance, but backing up a little bit, the TCJA, which was the 2018 Tax Act, basically capped state tax deductions as an itemized deduction to $10,000 per return if you're married filing joint. So for taxpayers and maybe a higher income bracket, and maybe with some real estate taxes and personal property taxes, this reduced their deduction and then made it so that they could not take as much. A lot of states, particularly some high tax states, developed some workarounds, and it was this pass-through entity election sort of has become in vogue. Mentioning this because Virginia just issued their draft guidance, I believe it was October 31st. Virginia requires a 30-day public comment period, so they are accepting comments through, I believe, the end of this month, and then they will work to issue some final guidance. And basically what this allows you to do is elect to pay your state taxes through your pass-through business, so a partnership or an S corporation, and potentially take the tax deduction at that level versus your individual tax return through your itemized deduction. So it may actually, it's a workaround so that you can maybe deduct more than the $10,000 cap. Again, Virginia's regulations are not final. They are working on that. So for those who are based in Virginia like myself, it's something to be mindful of, as we may need to be paying those taxes by the end of the year, December 31st. So we have about 6 weeks to make decisions and be proactive about it. So if you do have a pass-through business, again, a partnership or an S corporation that pays Virginia tax, or you as an investor or an operator are liable for Virginia tax, something to talk to your tax advisors about.
Great.
And again, here are a list of states in case you're sourcing income or operating in other states outside of Virginia. Here's a list of some of those. So it may need to be a broader conversation than just Virginia, just depending on where your income situation is.
Yeah, definitely. As an NA bank, we have customers all over. Well,
All right,
great. Well, this
that
was
was sort
really
of it.
wonderful.
Yeah, if anyone has any questions, I've been monitoring the Q&A, but feel free if you have any questions, happy to stay on for the next handful of minutes and answer anything that you guys had questions about.